If you're new to investing and feeling overwhelmed, confused, or scared, you're not alone. In this video, I'm going to show you the best way for beginners to start investing step by step. This is the guide I wish I had when I was first starting out. I'll break it down into 5 easy parts: why you should invest, what to invest in as a beginner, when and how much you should invest, how to buy your first stock with a real example of me doing it, plus investing strategies and important things you should know about, like taxes. All right, let's start with the most important question. Why should you invest? The main reason is to make your hard-earned money work for you so that you can make more money over time. Let's say you have $100. Most people would either spend it or put it in their savings account. But here's the problem: inflation. Every year, things get more expensive, and that same $100 will buy you less in the future than it does today. For example, back in the year 2000, a McDonald's Big Mac cost $2.50. Today, it's over $6. That's inflation slowly stealing your money's value. So the smartest thing you can do is invest your money so that it grows. Now, when you invest, your money grows in 2 main ways. First, when you buy a stock like Amazon, for example, you're actually buying a small piece of that company. So if Amazon grows, meaning it sells more products, makes more money, and becomes more valuable, then Amazon will be worth more. And since you own a piece of it, your investment will be worth more too. The second way your money grows is through something called compound interest. This is when your money makes money, and that money makes you even more money. Let's say you invest $1,000 a month with a 10% return. After about 6 years, you would have around $100,000. But here's where it gets wild. The next $100,000 could take less than 4 years, the one after that less than 3 years, and it keeps speeding up from there because you're now earning 10% on a much bigger balance. That's the power of compound interest, and it's why it's so important to start investing as early and as often as you can. So what should you actually invest in? Most beginners make the mistake of chasing whatever hot stock is popular at the moment, but that could be a huge mistake. Just because a stock did well before doesn't mean it'll keep going up in the future. Take Zoom, for example. In early 2020, Zoom stock was around $70. By October 2020, it jumped to over $550. A lot of people saw that and bought into the stock thinking it would keep going up. But today, this stock is worth around $70. So anyone who bought at the top lost a lot of money. This is why chasing popular stocks can be risky. Just because something's doing well now doesn't mean it will in the future. So instead of picking individual stocks, the easiest and safest way to start investing is with index funds. Even Warren Buffett, one of the best investors in the world, says that both large and small investors should stick with low-cost index funds. But what exactly is an index fund? Well, the word index just means a list of companies. For example, the S&P 500 is a list of the top 500 biggest companies in the US. And the word fund means a collection of money from different investors like you and me that's used to buy investments like stocks. So when you invest in an index fund, you're basically buying small pieces of all the companies on that list. One of the best things about this is that it helps lower your risk. Instead of putting all your money into one stock and hoping that it takes off, you're spreading it across hundreds of companies. So if one company struggles, it won't ruin your entire investment because the other companies help balance it out. This is overall a simple, way less stressful way to grow your money over time. Okay, now let's look at what an index fund actually looks like. For this example, we're looking at one of my favorite index funds, FXAIX, which tracks the S&P 500. When you buy this index fund, you're investing in 500 of the biggest US companies like Nvidia, Microsoft, Apple, Amazon, Tesla, and many others. So instead of buying each of those stocks one by one, you can just buy one share of FXAIX and own a piece of all of them. Now, if you want to know exactly what companies you're investing in, you can check the portfolio section. For example, these are the top 10 holdings for FXAIX. Nvidia makes up about 7%, Microsoft is also around 7%, Apple is about 6%, Amazon is around 4%, and the list goes on. So if you want to invest for the long term and keep things simple, you can just invest in index funds or ETFs like FXAIX, SPLG, VOO, SPY, or IVV. They all do the same thing, track the S&P 500, they're just from different companies. Now, before you start investing, it's very important to look at the expense ratio. These are fees that are taken out automatically from your account to cover the cost of managing the fund. For example, if a fund has a 1% expense ratio and you invest $10,000, you would pay $100 a year in fees. So it's best to pick a fund with a low expense ratio, preferably under 0.5%. For example, the FXAIX expense ratio is only 0.015%. So for every $10,000 you invest, you're only really going to be paying $1.50 a year in fees, which is super low. So here's what I recommend. Pick a fund that tracks the S&P 500, is affordable to you, and has a low expense ratio. That way you don't lose a lot of money on fees. The reason I recommend the S&P 500 is because it gives an average return of 7 to 12% a year. That doesn't mean you're going to get that every single year. Some years will be more, others may be less, but over time, it usually earns a nice 7 to 12% a year. Now that you know what to invest in, the next question is, when should you start investing? The answer depends on two things. One, if you have high interest debt above 7 to 12%, the answer is no. You should pay that off first before investing. Think about it like this. The stock market averages about a 10% annual return. But if your credit card is charging 20% interest, paying that off is like getting a guaranteed 20% return. For example, let's say you owe $10,000 on a credit card with a 20% interest rate. That's $2,000 a year you're paying in interest. But if you use that $10,000 to pay off your debt instead, you could save $2,000 in interest. That's like getting a guaranteed 20% return, which is way more than what you would most likely make investing in the stock market at a 10% return. The second question is, do you have a 3 to 6 month emergency fund? An emergency fund is money set aside for unexpected things, like if your car breaks down or, God forbid, you lose your job. The point of it is to help you out in those bad situations so that you don't end up getting into debt or, even worse, selling your investments at a loss to cover your emergencies. So before you invest, make sure you've paid off your high interest debt and you have an emergency fund. Now let's talk about how much money you should invest. A lot of people think you need a lot of money to start investing, but the truth is you can start with as little as $1. However, how much you earn depends on how much you invest. In other words, the more you invest, the more your money can grow. For example, if you invest $10 and the stock goes up 10%, you make $1. But if you invest $30,000 and it goes up 10%, you'd make $3,000, which is a huge difference. Now, the money you invest should be money you don't need right away. Money you can leave alone for a few years, like 5, 10, or even 20 years. For example, if you're saving for a house and need the money in a year or two, don't invest it, because the stock market is unpredictable and it can go up or down in the short term. It's better to put that money somewhere else, like in a high-yield savings account, so that it grows safely and is ready for you when you need it. Now let's talk about how to invest in your first stock or index fund. To make it easy, I'll show myself buying a real stock. So there are two main ways you can invest. The first way is with a retirement account like a 401k or a Roth IRA. The benefit of using these accounts to invest is that they can help you save on taxes. But the downsides are that you can only put in a certain amount of money each year, and to take out your earnings without paying taxes or penalties, you usually have to be at least 59 and a half years old and have had the account for at least 5 years, or you have to meet certain exceptions. Now, if you don't have a retirement account and want more flexibility, another option is to use a brokerage account. The great thing about a brokerage account is you can invest in as much as you want and withdraw your money whenever you want. But the downside is that it doesn't offer the tax benefits of a retirement account. Now, opening a brokerage account is super easy. You can open one with different companies like Fidelity, Vanguard, Robinhood, or Charles Schwab. For example, if you want to open one with Fidelity, you can just search open an account with Fidelity and then choose the account you want to open, whether that's a Roth IRA or a brokerage account. After that, you'll need to fill out some basic information like your name, social security, and your date of birth, which should only really take you a few minutes. Once you have your account, you can then go to your dashboard and click on transfer. That way you can link your bank account and be able to deposit money into your account. Once you have some money in your Fidelity account, you can then go back to your dashboard and click on this magnifying glass icon to search for the stock or the index fund you want to invest in. For this example, I'm going to buy FXAIX. As you can see, one share of this index fund right now costs about $220. However, you don't have to buy the whole share if you don't want to. You can also buy part of a share called a fractional share. For example, if you wanted to buy one share, you can click trade, select your account, select buy, and enter the price for one share, in this case $220 with 51 cents. Then click preview order and place order, and that's about it. But if you only have, let's say, $50, you can also just change the amount to $50 or whatever amount you want to invest, and you'll buy a fractional share instead. So as you can see, you don't have to be a multimillionaire to start investing. You can invest with whatever money you have and grow your portfolio little by little. Now, if you wanted to buy an individual stock instead, like let's say Apple, you would do the same thing. Just search it up here, click trade, and then buy. Next, choose if you want to buy a certain number of shares, like one share, or a specific dollar amount, like $100 worth. Then select market if you want to buy at the current price of $219 with 56 cents, or limit if you only want to buy if the price of Apple drops to a certain price, like let's say $200. After that, click on preview order, and just like that, you're officially an investor. Now let's talk about how long you should hold and invest in stocks before selling. For beginners, I suggest holding your investments for the long term, like 3, 5, 10 years, or even longer. The key is to buy and then just leave it alone. Because if you check your investments every single day, you might see the market go down one day and panic sell. And panic selling is how most investors lose money in the stock market. For example, let's look at SPY, an ETF that tracks the S&P 500, the 500 largest companies in the US. Imagine you bought a share of SPY in October 2007 for $154, and your plan was to hold it and let it grow over time. But then the 2008 financial crisis hit and the entire stock market crashed. Most people at this point would start to panic and sell because they're scared it'll keep going down. But if you take a step back and you use logic instead of fear, history shows us again and again that markets recover. And something important to keep in mind is that you haven't lost anything until you sell. So even though SPY dropped from $154 to about $73, you still own that one share. And you only really lose money if you sell at a loss. Fast forward to 2013 and SPY went back up to around $154. In 2015, it went up to about $209. In 2018, it went up even higher to about $291, so you almost doubled your money, and today SPY is currently around $630 per share. That's about 4 times your original investment just by holding long term. The big lesson here is that the stock market rewards patience. If you ignore the ups and downs, trust the process, and keep holding, you'll see that the market tends to go up over time. So there's no need to stress about daily changes, especially if you're invested in an index fund tracking the 500 biggest US companies. Just invest little by little and ride the waves. Studies actually show that if you miss just 10 of the best days in the market because you were selling when the market was down and try to buy when it was going up, you can lose over half of your gains. For example, if you invested $100,000 and you left it alone, it might grow to over $200,000 over time. But if you keep buying and selling, you might only end up with $144,000. That's why it's important to hold long term, because timing the market is impossible, which is why timing the market matters more than timing the market. I personally dollar cost average, which means buying a set amount no matter the price. And to make it easier, I automated my investing by linking my bank account to my Fidelity account. So every single month, it automatically buys a fixed amount of FXAIX no matter how the market is doing. This helps me invest consistently and stops me from watching the market all day, which can lead to emotional panic selling. Now let's talk about taxes. How much you pay in taxes depends on how much money you make or lose when you sell your stocks. For example, if you buy a stock for $1,000 and you sell it later for $2,000, that means you made $1,000 in profit, and you're going to have to pay taxes on those $1,000. But if the stock price goes down to $700 and you sell, that means you actually lost $300. You can use that loss to reduce your taxable income. How much tax you pay also depends on how long you hold the stock. If you sell before 1 year, the IRS considers it short-term and it taxes it more. But if you hold it for more than a year, it's considered long-term and it gets taxed less. Also, the type of account you use to invest can affect your taxes. So choosing the right account is just as important as picking the right investments. If you want to learn more about investment accounts and the best places to put your money to build wealth and even save on taxes, make sure to check out this next video. So hopefully this gave you guys a clear idea of how to invest for beginners. If you found this video helpful, please don't forget to subscribe. Over 90% of you watching haven't subscribed yet. So if you like these videos and you want to support me and the channel, please make sure to subscribe and turn on those post notifications so you never miss out on a video. Thank you guys so much for watching today's video, and I'll see you guys on the next one.